Hello there, and welcome to the first episode of Common Sense About Your Money. My name's Randy Beeman, and I am the Director of Wealth Advisory Services at Glass Jacobson Wealth Advisors. We are a full-service financial planning and wealth management firm, and we have offices in Maryland and Virginia. Every month in this podcast, we're going to bring you varying information about the investment markets, the current economic environment, financial and estate planning, some important tax and retirement planning topics, and hopefully some insightful commentary and what you think is interesting discussion. I'll typically be the regular host, but I'm often going to be joined by other members of our team to discuss various financially related topics. Now, we understand that everybody has got busy lives today, so we're going to try to keep each show to around 15 or 20 minutes, give or take. That way you can watch it while you're working out, or maybe while you're having lunch, or you could just listen to the audio portion whenever you're driving to or from work or dropping the kids off at school or maybe at a sporting event like soccer. All right, well, that's enough introduction for today. Let's get started. When I was thinking about the topic that I wanted to discuss today, I went to Google and I did some digging around. And it turns out the number one most asked financial question on Google in the last 30 days is, when will interest rates come down? Tens of thousands of folks wanted to know the answer to that question. Unfortunately, I have to tell you today, the correct answer is nobody knows. That's right. Nobody really knows for sure when interest rates might come down. I don't. I bet not even the one person who's most responsible for setting interest rate policy in the United States, the chairman of the Federal Reserve, his name is Jerome Powell, I bet you he doesn't even know for sure when rates are going to drop. And that's because the factors that have an important role in determining the level and direction of interest rates are variable and they're constantly changing. Factors like economic growth rates, unemployment levels, current inflation levels, and the likely direction of future inflation all get lumped into the cauldron of witch's brew the members of the Federal Reserve Board stare into at each meeting and try to decide what they should do with interest rates in the U.S. So even though I can't give you a definitive answer today, we can try to figure out what might happen. At least by knowing what the odds are of a particular outcome, you can be better prepared to manage your personal financial life as the future does unfold. But in order to better understand what might happen in the future to rates, you have to have a good understanding of how we got to this point in the first place. Now, here's an aside note. The next couple of minutes is important stuff to talk about, but it is kind of complicated and it, for some of you, might be pretty boring. So I'll try to keep it as interesting as I can so you don't tune out or nod off to sleep. So here we go. The federal funds target rate is one of the key tools the Federal Reserve uses to direct monetary policy in the United States. The current Fed target rate, federal funds target rate, is 5.25% to 5.5%. Now here's a geek alert. Before 1990, the Federal Reserve didn't even announce a Fed funds target rate. So you had a lot of trouble trying to figure out the direction of interest rates back then. But today they do give you a target rate, and the current rate is 5.25% to 5.5%. Now, why should you care what the Fed target rate is? Well, you should care because it pretty much impacts everything in your financial life, from the annual percentage rate you earn on your savings and your CDs and in the money market accounts you have at the bank, all the way to the rate you pay on your credit card or your mortgage. They're all keyed to the Fed funds target rate. So I could launch into a long dissertation here about how the Fed rate works within the financial system and, how it guides U.S. interest rates in a lot more detail, but that discussion is certainly going to bore most of you to death. Unless you're an aspiring economist or have a burning desire to know how everything works, in which case you can find a reasonably good explanation on Wikipedia. But for our purposes today, let's just say the Fed funds rate pretty much drives most interest rates in the United States. Now, let me step back and remind you, the current Fed funds rate is 5.25% to 5.5%. The historical high was back in December 1980, when it soared to 22% to combat double-digit inflation. Remember when Jimmy Carter was president? The historical low wasn't all that far back. It was 0%, and we hit that in 2008 when the Fed was trying to revive the economy during the great financial crisis. They dropped it to that level again in 2020 to help minimize the fallout from the COVID-19 pandemic. So I think personally, one of the reasons that so many people want to know from Google when interest rates are going to drop and why it feels like interest rates are high right now is because we've gotten used to abnormally low rates being in place for such a long period of time since 2008. The Fed dropped their Fed funds target rate to 0 to 0.25% in December 2008. And they kept it at those rock bottom levels until December 2015. 7 years of near zero interest rates. During that time, a lot of homeowners refinanced at low rates, sometimes 2 to 3%, and businesses took advantage of issuing bonds to raise capital with historically low coupons. Everybody got pretty used to having access to what seemed like free money. Even when the Fed started moving rates up from the cellar, they went so slowly that it took a year to increase the target rate by just 1%. Then, just as rates were starting to get back to close to something closer to the long-term average in early 2020, wham, along comes COVID-19, and the Fed had to cut rates to 0% again in March 2020 to try to offset the impact of the economic shutdown. Let me show you a chart here that illustrates what I'm talking about. So here you can see, this is produced by the St. Louis Federal Reserve website. It's a chart of the federal funds effective rate going back into the 50s. And you can see here the peak in December of 1980 at 22%. Then we had a long-term decline. The Fed tried to raise rates in here, and then all of a sudden, the great financial crisis hit. We had this recession in this gray bar. They dropped it to 0 in December of 2008, and they kept it there for 7 years. That's when everybody took advantage, or a lot of people took advantage, of refinancing every loan they had at a low rate. Then they started to try to move it up again, and the COVID-19 pandemic hit, so they had to drop it to 0% again. It stayed at 0% for a period of time, and then most recently they've been moving it up, and here we are now in February at 5.25% to 5.5%. So that gives you a good graphic representation of how long interest rates have been at such low levels. We had rates historically low for 2 years after the COVID-19 pandemic, and everybody took advantage of it. The homeowners that missed the chance to get long-term mortgages with rates under 3% the first time, and businesses that missed the boat and didn't raise new capital, jumped on the chance to load up their balance sheets with low-cost borrowing. Even the federal government couldn't resist bellying up to the trough by running up the level of debt with rates so low. It was March of 2022 before the Fed could feel comfortable moving rates up again. And as I mentioned, at first it tried to go slowly. It raised 25 basis points the first time in March of 2022. Another geek alert, 25 basis points is 1/4%. So they went up 1/4% in March of 2022. Then they went 50 basis points in May of that year. And then all of a sudden they realized the inflation genie had gotten out of the bag big time, and they put their foot on the gas and they raised rates 4 times, 4 increases of 75 basis points each. Following that, they raised rates 5 more times until July of 2023, when the rates hit where they are today at 5.25% to 5.5%. Now we've got some historical context. Let's get back to the original question that everybody seems to want to ask Google is, when will interest rates come down? The Fed has told us in their economic projections that they put out at their meetings, they expect the Fed funds target rate to be at 4.6% by the end of 2024. Now, that's assuming they hit their inflation targets, which is a little bit beyond my scope of discussion here, but they're projecting a 4.6% Fed funds target rate by the end of 2024. Well, if the Fed funds target rate today is 5.25% to 5.5%, and they expect rates to be 4.6 by the end of this year, I'm no economist, but I think that means they expect to lower interest rates by about 1% sometime this year. Now, they already had their January meeting and they left rates alone. They didn't do anything. In the press conference after the meeting, and again on February 4th on 60 Minutes, Jerome Powell said the time is coming for rate cuts, but he strongly indicated it might not be coming in their next meeting in March. The equity market reacted negatively to that because it had priced in the expectation that they were going to lower interest rates in March. The next meeting after March is at the end of April and early May. And they'll have 5 more meetings after that in 2024. So they have lots of time to decide if and when they'll start moving rates lower if they plan to hit their expected target of 4.6% by year end. By the way, in the same economic forecast, they projected rates would end the year of 2025 at 3.6% and reach 2.9% by 2026. So they're projecting that they're going to be lowering interest rates for several years. Keep in mind, all those projections are predicated upon a lot of variable economic information. But if they're even close to right, and that's a pretty big assumption because the Fed's track record on predictions is pretty spotty, but let's give them the benefit of the doubt. Let's say if they're even close to right, interest rates are destined to come down from current levels over the next several years. But absent some unexpected shock to the financial system, like maybe, what economists actually call a black swan event, stuff like maybe another pandemic or widespread war, election chaos, which is possible this year, it doesn't seem like rates will be back near 0% anytime soon. So absent some kind of outside event occurring that surprises them, I don't expect rates to be back to 0% anytime in the near future. So what does all this economic jargon and the potential for higher rates for longer mean to the economy and to you and your personal financial health? Let's talk about some of the impacts to the economy first. Higher rates on all types of commercial loans make it harder for businesses to secure cost-effective credit for expansion and growth opportunities. That means slower growth and slower earnings. For companies that already have loans in place, most loans for businesses, whether they're borrowing the money for growth or acquiring things like commercial property, most of those loans have variable interest rates. The loan resets at various periods of time. And the loan could be resetting at much higher levels now than when they took out that loan whenever rates were near 0%. For every business in this predicament, it at least means higher costs of debt service. And for some businesses, it might mean they can't even cover that extra cost and they'll just go under. In the commercial real estate sector, this is actually compounded by low occupancy rates as a hangover still from the COVID, not many people going back to the office. Higher costs of doing business, if continued long enough, can lead to inflation increases. And if happens, that's a problem for the Fed because it's above their projected comfort zone, which means they're not going to be as likely to lower interest rates. Higher inflation is a result as a fact of companies pass these higher costs on to customers, and you and I end up paying higher prices. It also could potentially mean cutbacks in staffing, which adds to higher unemployment levels. And higher mortgage rates have dampened the level of activity in the housing market in a couple of ways. The increased cost of debt service from higher rates have squeezed out some buyers out of the market or caused them to search for, maybe a house that's a little lower priced. And then secondly, those people that were lucky enough or smart enough to secure a new mortgage or refinanced when rates were at 0, essentially, and they could get a 2 or 3% mortgage, they're not easily going to give up that mortgage and move somewhere else because they're going to have to get a new mortgage at a higher rate. So that's kept the housing stock at historically low levels and kept prices abnormally elevated. So that's just some of the broader economic impacts of higher rates for longer, potentially. So how is it potentially might directly more impact you? Well, one big way, have you looked at the interest rate on your credit cards lately? You might not want to look at it, but you should take a peek anyway. Some of you are going to open up that envelope and discover you're paying maybe 20% or more a year interest on your credit cards. After you pick yourself up off the floor, you should probably make yourself a promise not to maintain a large balance if you can. As a general rule, and not everybody could do this, but you should pay cash for anything that's likely to depreciate in value and only finance items that could appreciate. It's hard to do that, but if you can do that, that's the rule that I would suggest you try to follow. Let's talk about car loans. The rate on new cars is bought down in some cases by the car companies as an inducement to sell the car. You've probably seen those ads on TV, 2% loans for 72 months or something like that. Don't be fooled, though. Car companies aren't just being nice guys and giving you a low interest rate. You're paying for that rate somehow. It's usually buried in the higher upfront fees on the loan, or it's built into the cost of that $70,000 car you're financing for 72 months. But you're paying for that lower interest rate somehow. If you get a loan for a used car, you're going to find those rates are a lot higher usually. So again, the same rule applies. If you can, try not to finance assets that are going to go down in value. Pay cash for as much as you can for those kinds of purchases. One positive impact of higher rates has been the ability to buy secure income instruments like U.S. Treasuries with actual real yields for the first time in a decade. This is a really pretty big deal. For many years, you couldn't buy real bond or treasuries that had any yield. You had to buy other things that had income as a proxy for a real bond or treasury. And when those rates were pegged to zero, you were stuck having to do that. But now, high quality bonds, whether they're muni bonds, corporate bonds, treasuries, as well as savings accounts and money market accounts, are now offering right around 5% or so. And with inflation levels at around 3%, you're actually getting real yield investments for the first time in a long time. So that's a positive, actually. So I hope this discussion of the direction and level of interest rates hasn't been too boring. Maybe you've gotten a little bit of information from it. Each month, we'll try to bring you a unique perspective on financial topics, and as best we can, try to translate the sometimes hard to understand financial jargon into everyday terms, make it easier for you to understand, and try to relate it to your individual situation. If you have a question for us or a future topic you'd like to suggest, you can email us at info@GJW Advisors. Thanks for sharing some time with me today, and until we get together again next month, I wish you and your loved ones a secure and prosperous future.